Jack Bogle died in January 2019 at 89 years old, and by any measure at all, he won. Not because he got rich, though he certainly did. He won because he changed the way ordinary people build wealth. Before Bogle, investing was mostly a game for institutions and professionals. It was expensive, it was opaque, and the deck was stacked against the average person. Then Bogle walked in, looked at decades of data showing that most professional fund managers cannot consistently beat a simple index over time, and said, "So why are we paying them to try?" He created the first index fund available to individual investors, founded Vanguard, and spent the next 4 decades making the case for the simplest possible investing strategy: own the market, pay as little as possible, wait. And the most enduring expression of that philosophy became known as the 3-fund portfolio. 3 ETFs, that is all it takes. 1 for US stocks, 1 for international stocks, 1 for bonds. No individual stock picking, no market timing, no hot tips, just 3 funds, consistent contributions, and time. Millions of people have built real wealth with this exact strategy. It is genuinely brilliant. But here is the honest question I want to explore with you today. The world Bogle built that strategy for is not the world we are investing in right now. Bonds were paying 5 to 6% when this strategy was designed. International markets were delivering competitive returns, and a new generation of ETFs exists today that simply did not exist when Bogle was working. So what would the 3-fund portfolio look like if you built it from scratch in 2026? What if you kept everything brilliant about the core idea: simplicity, diversification, low cost, consistency, but updated the actual building blocks for how the modern market works? That is exactly what we are going to find out today. I am going to walk you through the original 3-fund portfolio, show you the real numbers it produces, explain honestly where it has started to age, and then reveal the modern upgrade. Same 3-fund structure, same discipline, same $10 a day starting point. But at the end, we are going to compare the 2 versions side by side with full 30-year projections, and the gap between them is going to be larger than you expect. Let's get into it. Let me start by laying out exactly what the classic Bogle 3-fund portfolio contains, because a lot of people have heard the phrase without fully understanding what makes it work. The 3 funds are VTI, the Vanguard Total Stock Market ETF, VEA, the Vanguard FTSE Developed Markets ETF, and BND, the Vanguard Total Bond Market ETF. The classic allocation is roughly 50% VTI, 30% VEA, and 20% BND, and each one of those positions has a specific, deliberate job. VTI is the growth engine. It tracks the entire US stock market, not just the 500 largest companies, but every publicly traded company in the United States. That is roughly 3,500 to 4,000 companies spanning every size and every sector. Apple and Microsoft sit alongside thousands of smaller companies that represent the full breadth of American commerce. When the US economy grows, VTI grows with it. In 2025, VTI returned approximately 17.1%, consistent with a strong year for US equities. The 10-year annualized return sits at around 14.8%, one of the strongest long-term records of any broad market fund in existence. Over a 30-year window, this is the piece of the portfolio that does the heavy lifting on wealth creation. It is the reason the strategy works. VEA is the diversification layer. It gives you exposure to large and mid-cap companies in developed markets outside the United States, Europe, Japan, Australia, Canada, the UK, Switzerland, Nestlé, ASML, Toyota, Roche, HSBC, genuinely high-quality global businesses. The original argument for VEA was one Bogle believed deeply. Geographic diversification protects you from country-specific risk. If something happens to the US economy specifically, a domestic recession, a political crisis, a currency event, and then owning international companies means your portfolio does not fall entirely. VEA currently yields approximately 3.2%, which is meaningfully higher than VTI's approximately 1.3% yield, giving the portfolio an income boost from the international sleeve. BND is the stability net. It holds thousands of US investment-grade bonds, government treasuries, corporate bonds, mortgage-backed securities, and its entire purpose is to cushion the portfolio when stocks fall. When equities crash, bonds have historically held their value or risen as investors seek safety. In 2008, when the stock market lost roughly 37% of its value in a single year, BND was essentially flat. For an investor who needs to draw from their portfolio during a market crash without being forced to sell stocks at the worst possible moment, that stability is enormously valuable. The current yield on BND is approximately 3.8%, which sounds reasonable until you compare it to what bonds were paying when this strategy was designed, and until you look at what BND has actually delivered in total returns over the last decade. Put all three together at the 50-30-20 split, and the blended portfolio produces approximately a 2.2% dividend yield, a 7.5% annual dividend growth rate, and 7.2% annual price appreciation. Those are stable, reliable numbers. Now let us see what they actually produce over 30 years, starting from just $10 a day, $300 a month, $3,650 a year, with all dividends automatically reinvested. After 10 years of consistent contributions, approximately $57,000. After 20 years, approximately $197,000. After 30 years, the total portfolio value reaches approximately $545,000. And by that 30th year, the portfolio generates around $11,400 per year in dividend income, roughly $947 a month in completely passive income. That is a genuinely meaningful outcome. Building $545,000 and $947 a month in passive income from a daily contribution, the size of a takeaway coffee, is exactly the kind of quiet wealth creation Jack Bogle spent his entire career advocating. The strategy works. It has always worked. What I want to show you now is how much better it can work with the updated building blocks available today. Before I reveal the modern version, I owe you an honest explanation of where the classic portfolio has started to show its age, because swapping out funds without explaining why would be lazy advice. The three-fund portfolio was designed for a specific economic environment. Today, that environment looks meaningfully different in three important ways. First, bonds. When Bogle built his framework, bonds paid 5 to 6% annually and served as a genuine return contributor alongside their stability role. That is simply not the world BND lives in anymore. Over the last decade, BND has averaged less than 2% in total annual return, and in 2022, when interest rates rose sharply, BND did not provide the stability it was supposed to deliver. Stocks fell, and bonds fell with them. BND lost approximately 13% of its value in 2022, one of the worst years for bonds in decades. The fundamental promise of bonds as a portfolio stabilizer was tested in 2022, and it failed in a way that hurt investors who were relying on that non-correlation. The fund has since recovered, but the experience exposed a real limitation in the traditional case for bond allocation. You are using 20% of your portfolio for a position that has averaged less than 2% returns for a decade and then went down alongside your stocks in the exact moment you needed it to hold. Second, international developed markets. For the better part of 15 years, U.S. stocks have dramatically outperformed developed international equities. There have been brief windows of international outperformance, but the overall trajectory has heavily favored the U.S. Part of the reason is that the largest U.S. companies, Apple, Microsoft, Google, Amazon, are already global businesses. They generate revenue from every country on Earth. When you own VTI or VOO, you are already getting meaningful indirect exposure to global economic activity through these companies' international revenues. The incremental diversification benefit of a separate international fund is smaller today than it was when U.S. and international markets were more structurally distinct. Third, and most importantly for the modern upgrade, new generations of ETFs now exist that combine income and growth in ways that were not available when Bogle built his framework. A fund like SCHD, which did not exist until 2011, delivers a growing dividend yield significantly above BND, while also providing meaningful capital appreciation. The idea that you have to choose between income and growth, that you need bonds for income and stocks for growth, is a false trade-off in 2026. There are ETFs built specifically to deliver both, and building a portfolio around them produces dramatically better long-term outcomes without sacrificing simplicity or discipline. Here is the modern three-fund portfolio. Same structure as Bogle's original. 3 funds, clear roles, low costs, simple to maintain. VOO at 40%, SCHD at 30%, and INTF at 30%. The first position is VOO, the Vanguard S&P 500 ETF, replacing VTI as the U.S. core. VOO and VTI are close cousins. Both are from Vanguard, both are extremely cheap, and over most time periods they perform nearly identically. The practical difference is concentration. VOO owns the 500 largest U.S. companies. VTI owns those 500 plus several thousand additional smaller companies. Over the last decade, VOO has slightly edged VTI in performance because the mega-cap technology companies that dominate VOO, and the Apples, Nvidias, and Microsofts, have driven returns more powerfully than the broader market, including small and mid-cap stocks. The expense ratio is 0.03%, essentially free. The 2025 total return for VVOO was approximately 25%. The 10-year annualized return sits at approximately 13.3%. For the core growth engine of the portfolio, VVOO's concentration in the most proven and most profitable large-cap companies is a small but meaningful refinement. The second position is SCHD, the Schwab U.S. Dividend Equity ETF, replacing BND entirely. This is the most consequential change in the entire upgrade and the one that drives the most dramatic improvement in long-term outcomes. Instead of a bond fund generating 1 to 2% annual returns with meaningful interest rate risk, you now hold a fund that currently yields approximately 3.4%, has grown its dividend at roughly 9 to 11% annually over the last decade, and has delivered approximately 9 to 10% annualized total returns over the same period. SCHD screens for companies with at least 10 years of consecutive dividend payments, strong free cash flow, and growing shareholder returns. The top holdings include Broadcom, Home Depot, Coca-Cola, Chevron, and Cisco, among the most durable, highest-quality dividend-paying businesses in the U.S. economy. The income SCHD generates is real, it grows every year, and the underlying share price appreciates over time. This is not a bond substitute. This is a superior income solution that serves the same role in the portfolio, providing cash flow and stability, while delivering far better long-term returns. In terms of what the compounding math produces at the 30-year mark, this single swap from BND to SCHD is responsible for the majority of the gap between the two portfolio projections. The third position is INTF, the iShares International Equity Factor ETF, replacing VEA in the international sleeve. INTF is not a passive index that simply buys every company in developed markets outside the U.S. It applies quality factor screens to identify financially strong, fundamentally sound international companies, and excludes the weaker ones that a plain market cap-weighted international index would include automatically. The result is international diversification tilted toward the best businesses in those markets rather than an undifferentiated slice of everything. The current yield is approximately 3.5%. And the dividend growth rate has been in the mid to high teens, exceptional for an international fund and well above VEA's historical growth rate. You keep the geographic diversification that Bogle correctly valued, but you access it through a smarter filter that has historically produced better outcomes. It is the same principle Bogle himself applied when he argued for index funds over active management, but applied at the sub-index level to select quality within the international universe. Now the numbers. The modern portfolio, VOO at 40%, SCHD at 30%, INTF at 30%, produces a blended dividend yield of approximately 2.5%, a blended dividend growth rate of approximately 11.5% per year, and blended annual price appreciation of approximately 7.7%. The yield is only marginally higher than the classic version, but the dividend growth rate, 11.5% versus 7.5%, is where the compounding divergence begins. 4 extra percentage points of dividend growth per year, compounding every year for 30 years, creates a gap that starts small and becomes extraordinary. The 30-year projection for the modern portfolio, starting from the same $10 a day with all dividends reinvested. After 10 years, approximately $60,500. After 20 years, approximately $251,000. After 30 years, the total portfolio value reaches approximately $984,000, almost $1 million, from $10 a day. And by that 30th year, the portfolio generates approximately $60,900 per year in dividend income, roughly $5,075 every single month in completely passive income without selling a single share. Side by side, the comparison looks like this. Classic Bogle portfolio after 30 years, $545,000 in total value, $947 per month in dividend income. Modern upgraded portfolio after 30 years, $984,000 in total value, nearly double, and $5,075 per month in dividend income, more than 5 times as much. Same $10 a day, same 3-fund simplicity, same 30-year discipline. The entire difference comes from the dividend growth rate differential compounding over time and from replacing a historically underperforming bond position with a dividend growth fund that has delivered genuine wealth creation. The reason the dividend income gap is so much larger than the portfolio value gap is worth understanding. By year 30, SCHD's dividend has grown at roughly 10% per year for 30 years. That means the original dividend rate has been multiplied by approximately 17 times from compounding alone. Before you even count the new shares you bought with reinvested dividends over those 3 decades. And INTF's high dividend growth rate amplifies the same dynamic in the international sleeve. The dividend snowball in the modern portfolio is rolling dramatically faster than in the classic version by the final years of the projection. The same amount of capital generates dramatically more income because it was invested in funds that grow their income aggressively rather than funds that deliver fixed or slowly growing income. Before I close, there are 3 honest caveats I want to put on the record. The first is about projections generally. The 30-year numbers I shared are based on historical returns and reasonable forward assumptions. They are modeled outcomes, not guarantees. The stock market does not deliver smooth annual returns. There will be recessions, bear markets, and multi-year periods of poor performance inside any 30-year window. The investors who achieve outcomes close to these projections are the ones who stay invested and keep contributing through those difficult periods, not the ones who had the right funds and sold them when things got scary. The strategy is only as good as the execution. The second caveat is about SCHD specifically. SCHD underperformed the broader market noticeably over the last 2 to 3 years, as high-growth technology leadership dominated equity returns, and SCHD's more value-oriented holdings lagged. Some investors have questioned whether its historically strong dividend growth rate can continue if market leadership shifts. My honest view is that over a 30-year time horizon, SCHD's quality screening and dividend growth compounding create a structural advantage that shorter-term cycles do not erase. But if you hold SCHD, you need to understand there will be years where it significantly trails the broad market, and you will need the conviction to hold through that without abandoning the strategy. And the third caveat is about simplicity itself, which is actually the most important point of all. The reason the 3-fund approach works for so many people is not any particular fund. It is the simplicity that makes it easy to stay committed when markets are volatile, when the news is terrible, when every headline is warning about an imminent crash. A simple portfolio with clear logic is a portfolio you can hold with confidence. The moment it becomes too complicated to explain quickly, it starts failing human psychology rather than market math. The modern version I have described preserves that simplicity completely. 3 funds, clear allocations, automatic contributions, reinvested dividends. Any investor at any income level can start this today and run it for decades without needing to make complex decisions. Jack Bogle's philosophy was never really about specific funds. It was about trusting the market over time and refusing to let costs, complexity, or emotion get in the way of compounding. The modern 3-fund portfolio honors that philosophy completely. It just updates the execution for the world we actually live in now. If Bogle were building this portfolio today, with the funds available today and the knowledge of how the last 15 years played out, I genuinely believe this is the version he would build. And I think he would consider it a natural evolution of an idea he was always trying to refine toward better outcomes for ordinary investors. If this video helped clarify your own portfolio thinking, hit the like button and subscribe. I put out new content regularly on ETFs, long-term strategy, and building real wealth without complexity. Drop a comment below and tell me whether you are running the classic Bogle version, the modern upgrade, or something different entirely. I read every single one. I will see you in the next video.